Every autumn, a farmer walks the rows of his orchard and makes one decision. How much of this harvest do I keep, and how much do I hand over at the gate? For decades, Canada's answer to that question was unusually generous. You kept half of your investment success completely outside the tax net. Half the gain was taxable at your regular rate. The other half was yours, clean, untouched, invisible to the CRA. That single number, the inclusion rate, is the quiet hinge on which the entire Canadian dream swings. Your cottage, your rental duplex, the portfolio you built one paycheck at a time. In 2024, Ottawa announced that the gate toll was going up from 50% to 66.67%, two-thirds. And then it did not happen. Here is the part almost nobody has properly absorbed. In 2026, the inclusion rate is still 50%. It applies to individuals, it applies to corporations, it applies to trusts. The two-thirds rate never became law. But the reason this matters is not that you got away with something. It is that you have now seen, in writing, exactly what the government believes your gains are worth, and you know precisely where it will reach next time. Let me walk you through what actually happened, what it would have cost you, and what you do about it now. In April of 2024, the federal budget proposed raising the inclusion rate to two-thirds. For individuals, the higher rate would apply only to gains above $250,000 in a single year. For corporations and most trusts, there was no threshold at all. Every dollar, from the very first cent. The effective date was June 25, 2024. What followed was one of the strangest tax seasons in Canadian history. The measure was never passed into law, but the CRA began administering it anyway, because that is the convention. Accountants triggered gains that clients did not want to trigger. Business owners sold buildings ahead of a deadline that was never real. Families listed cottages that had been in the family for 3 generations. Then, on the 31st of January, 2025, deferred the whole thing to January 1st, 2026, and on the 21st of March, 2025, it canceled the increase entirely. So, think of it as a toll bridge on a private road. The government announced the toll, it painted the lines, it built the booth. Thousands of Canadians paid to cross before the price went up, and then the booth came down, and the road went back to being free. Now let us run the numbers, because the numbers are the reason this matters. Take a homeowner in the GTA selling a secondary property, a rental condo bought years ago, with a capital gain of $500,000. Assume a top marginal rate in Ontario of 53.53%. Under the rules that actually apply in 2026, half of that gain is taxable. $250,000 enters your income. The tax bill is roughly $133,825. Under the proposal that was canceled, the first $250,000 of gain would have been included at 1/2, and the remaining $250,000 at 2/3. Your taxable amount climbs to just over $291,000, and the bill lands near $156,134. The difference is roughly $22,300. On one transaction, that is the money that stayed in your pocket because a policy died in committee. Now scale it to the property that carries the most emotion in this country, the family cottage. A place bought in the 1980s for $100,000. Today it is worth $900,000. That is an $800,000 gain, and it is a gain that exists entirely on paper until the moment someone dies or someone sells. At today's 50% inclusion, the tax on that disposition is roughly $214,000. Under the canceled proposal, it would have been closer to $263,000, a swing of roughly $49,000. Understand what that difference represents in a real family. It is not an abstraction. When a parent passes, the CRA treats the cottage as though it were sold at fair market value on that day. The bill arrives, whether or not anyone has the cash. This is the trap. The asset is illiquid, the tax is not, and the estate has 90 days of grief and paperwork to find the money. $49,000 is very often the difference between keeping the place and listing it. And notice something the government said out loud during all of this. Because the $250,000 threshold was per individual. A couple who jointly owned a cottage with a $500,000 gain would have been fully sheltered. That design tells you exactly who the measure was aimed at, and it is worth remembering, because that architecture is now sitting on a shelf in Ottawa, fully drafted, ready to be lifted down. Corporations are the part of this story that got almost no coverage, and the part that mattered most. Under the proposal, corporations receive no threshold, not a reduced one, none. Two-thirds inclusion from the very first dollar of gain. Here is why that was so severe. When a corporation realizes a capital gain, the non-taxable half flows into something called the Capital Dividend Account, and that balance can be paid out to shareholders completely tax-free. It is one of the cleanest mechanisms in the entire Canadian tax system. On a $100,000 corporate gain today, $50,000 lands in that account. Under two-thirds inclusion, only $33,330 would have landed there. That is not a tax increase. That is the permanent narrowing of a pipe. Every incorporated professional, every holding company, every retained earnings retirement plan in the country would have felt it forever, not once. Which brings me to the way I want you to think about this going forward. Picture a cyclist climbing a mountain road. At low speed, the air barely touches you, but wind resistance does not rise in a straight line. It rises against the square of your speed. The faster you go, the harder the air pushes back. Double your pace, and you face 4 times the force. That is what a tiered inclusion rate is. A tax on momentum. Not a flat toll, but a headwind that strengthens precisely as you succeed. Ottawa built that machine, tested it in public for 11 months, and then switched it off. It did not dismantle it. So on any quiet morning in 2026, when you look at the assets you spent 30 years assembling, sit with this thought. You are, in a structural sense, a minority shareholder in your own portfolio. The CRA holds a floating stake, and the size of that stake is set by a single policy dial that a finance minister can turn in a budget speech. For 11 months, that dial moved. It can move again, which is why the strategy for 2026 is not growth, it is efficiency. 3 shields. First, the primary residence shield. Your principal residence remains the last untaxed goldmine in Canadian personal finance. If the property qualifies for every year you owned it, the entire gain is exempt. It survived the 2024 proposal untouched, and it was explicitly protected in every version. But you must report the sale on your return, even when the gain is fully exempt. Failing to report can void the exemption entirely. Second, the TFSA Fortress. Inside a TFSA, the inclusion rate is irrelevant. There is no gain to include. Growth, withdrawal, compounding, all of it sits outside the reach of any future dial turning. 5 years ago, a TFSA was a nice to have. In a country that has now demonstrated it will reprice capital gains by press release, tax-free compounding is worth many times what it used to be. Fill it first. Fill it completely. Hold your highest growth assets inside it. Third, the RRSP pivot. If you know a large gain is coming, a business sale, a property disposition, an RRSP contribution in that same year creates a deduction that lands directly against the taxable half of that gain. You are not avoiding tax. You are choosing which year and which marginal rate absorbs it. And one more thing that did survive all of this. The lifetime capital gains exemption was kept and indexed, sitting at $1,275,000 in 2026 for qualifying small business shares and farming and fishing property. If you own a Canadian-controlled private corporation, that number should be the center of your planning, not an afterthought. So here is where we land. Wealth in Canada is no longer a story about growth. It is a story about structure. The past 2 years proved that the rules governing your gains are not laws of nature. They are settings, and settings get changed. True freedom in 2026 is not owning assets that go up. It is owning assets that Ottawa cannot recalculate on your behalf. If you learned something from this video, like and hit subscribe. We'll see you in the next one.